Hey everybody, welcome back to Investing Unscripted, where we ask and answer the hard questions about investing. I'm Jason Hall, joined by the voice of the people, Jeff Santoro. Hey friend.
Hey, how are you?
I'm good. It's full-on summertime here. We're recording this July 1st, so getting it in before all the holiday travel starts. And this is another topic that was a little bit inspired from some conversation in our Discord for members of the starter position over on Patreon.
Yes, and I was glad to have that conversation kick up in the Patreon because this is something I think a lot of investors think about, whether they're new or experienced. I know this is something I think about constantly, and we'll talk about my own situation as we go through the episode here. But before we dive in, Jason, I want to take a quick second to put out a call for mailbag questions.
Yep.
We've been bad about remembering to do this in the weeks leading up to the actual record date, so I'm going to try to be better about that. So if you're listening and you have a question you'd like us to answer on the mailbag, we are recording it on July 14th. So from the time you hear this, you should have about a week, a little less than a week, to get us some questions for the mailbag. And we'd appreciate it.
Yeah, absolutely. And remember, the beauty of things like mailbags and email and social media broadly, asynchronous communication, right? You don't have to ask us like a couple of days before the mailbag. You could ask us like 2 days after the mailbag that you listen to, and we'll answer it on the next mailbag. We always need questions, I guess is the point. So definitely get those to us. All right. So the title of today's episode is Concentration versus Diversification.
Yeah. And when we first started talking about this idea, the thing that popped into my head first was this kind of being like Warren Buffett versus Peter Lynch. You know, Warren Buffett and Charlie Munger constantly talk about and have written about the idea of concentration and not having to be diversified. Now they are full-time, well, Charlie is no longer with us. Warren Buffett is a full-time investor, right? He has all the time in the world to read 10Ks and think about this kind of stuff. I'm about halfway through Alex Morris's awesome book, Buffett and Munger Unscripted, where it's just a compilation of all the things they've said at all the different meetings from the past 30 or so years. And the concentrated portfolio thing comes up very frequently. So whenever I think about concentrating my own portfolio, I have Warren Buffett's voice in the back of my head. And Peter Lynch, who was the investor leading the Magellan Fund at Fidelity for many years, he was notorious for crushing the market, but also owning hundreds of stocks and showing that you can have a market-beating investment style with a larger portfolio. And you know, you and I are both contractors for and have been members of the Motley Fool, and they talk a lot about being diversified and not having a concentrated portfolio, especially as you're learning and as you're a new investor, because then one mistake can blow you up and discourage you from investing further. But Peter Lynch and Warren Buffett are the two names that I think are kind of the avatars for this conversation, if I'm overgeneralizing.
Yeah, no, I think it's good. Those are the two good ones to cherry pick because two investors that obviously, there were a lot of similarities, but in terms of portfolio construction, two very different approaches that both delivered over the same period of time, by the way, extraordinary returns, absolutely extraordinary returns. I want to pull this. Here's a piece of data. This is up to date for Berkshire from its most recent 13F. There were 38 individual holdings, and that's come down. If you were to go back to the mid to late 2010s, I've been looking at their 13Fs pretty consistently, at least 3 times a year, usually every time it comes out every quarter. And I've never seen more than 55 stocks on the Berkshire portfolio. You might say, well, that's pretty diversified, and it's down to 38 now, so it's becoming more concentrated. But I'm going to give you 6 numbers: 26, 16, 11, 10, and 8. That's the percentages of the 5 largest holdings in the Berkshire portfolio. So what does that make up? 26 and 16s, 32, 42, 55, 54, 64. So it's roughly 70% of the portfolio is in 5 stocks.
Right.
That's extremely concentrated.
Yeah. And that aspect of the number of stocks versus the number of stocks that are a meaningful percentage of your portfolio is an aspect I want to dive into later, because that's related to what I constantly think about and struggle with. So I think I also want to just to lay groundwork for the conversation. I think we are largely going to talk about concentration versus diversification for people who are individual stock investors, either wholly or partially. there's a whole nother conversation you can have about diversification if you are just in index funds and mutual funds, right? There's the whole debate of, can you get away with just VOO, which is the S&P 500, and just dollar cost average into that for 40 years and be done with it? Or should you have more diversification beyond that? We're not going to really go down that road too much. We're going to talk more about, for those of us that like to buy individual stocks, how to think about concentration and diversification in that scenario. So let's start here, Jason. When I think about how concentrated or diversified someone should be, I think the number one, or at least one of the big things you have to consider is, how much time do you have to devote to researching stocks? Because I feel like the amount of time you have and the amount of interest you have in putting the work in should be directly correlated to how diversified or concentrated you are, meaning the more time you have, maybe you can get away with being more concentrated. Let's start there. What do you think about that aspect of deciding where to be on this continuum?
I would add to that, instead of just saying time, I would say resources at your disposal. Because one of the things that I think is really useful, Alex Morris's newsletter, Tyler's research that he does at Misfit Alpha, The Motley Fool, 7 Investing. There are a lot of really high quality individual shops and organizations that you can give a few $100 a year to that can be the top of your funnel to finding ideas. And I think there's 2 different approaches that you can take with that. You can use it how I did initially, which was basically trying to buy everything. When I first started, The Motley Fool was about the only game in town. There were others, but it was the easiest one that was, built for individual retail investors. And as a stock advisor and rule breaker member, there were probably 6 or 7 stocks a month that between new stocks they were introducing and what they called the best buys now, where I would just try to buy all of them a little bit, a couple $100 across all of them. And all of my disposable investing dollars was going into those. The other way to do it is just use it as the starting point for your research. And does whatever you're subscribing to, does it align with your total portfolio? Then maybe that's the way to go. Or if you have the time, and it's just these are your ideas, right? Your ideas list that you're using. I think it's a good shortcut to doing that. So I'd put those 2 things together though.
Yeah, I would agree. And we're going to talk about things like temperament and risk tolerance and time horizon as we go through the conversation. But even as I think about the time and the willingness and the resources to spend on researching stocks, I feel those other things play into it as well, because you can have all the time in the world, but you also need to have the guts to take the swing when the fat pitch comes. And I think that's the thing I think about for myself, right? If I were to make the decision to whittle my portfolio down to, let's just say 5 stocks or 10 stocks, like some super concentrated number, and follow that Buffett advice of be very patient, possibly wait years, but when the opportunity arises, jump in with both feet. Yeah. I don't know if I could do it. Like if I was just selling everything, building up a huge cash pile of, let's say 5 or 10 or 15 or 20% of my invested wealth in cash, and then maybe there's a big drawdown, maybe there's a great financial crisis again, maybe the market drops 30, 35%, and all of a sudden a stock I really like is cheap. Would I have the guts to put 20 grand into it? I don't know. I really don't know if I would. So I think there's that aspect of, yes, you might have the time, you might have the resources, you might have the interest, but you also have to have the constitution to actually execute what you say your strategy is.
Yeah, that's why one of the books, and actually another thing that just popped up in over in our Discord is a new member was asking for some suggestions for books to read. And whenever people ask me this question, I always bring up Lou Ann Lofton's book, Warren Buffett, Invest Like a Girl, and Why You Should Too, because it's the one book that I've read that is entirely around the idea of temperament, right? Because you can have the best stock picks in the world, but if it's a list of stocks that are highly volatile and your time horizon is maybe on the shorter end, there's no way that those stock picks are going to work for you, because if they're moving all over the place, being able to hold through that volatility is so important. The other side of that coin too is if you have the temperament to be able to get through those downturns and not fall to the fear side of yourself telling you to sell, and you can hold through those periods of downturn, the worst advice for you is to buy conservative, buy like the stalwarts that you're probably going to pay a high premium for. And they're going to do fine during downturns, but they're going to underperform when the market's going good. That's terrible advice. It doesn't match up with your needs or your temperament. So I always circle back around to how important temperament is and understanding who you are as an investor, because once you do that, then you can build a portfolio with the tools and the frameworks that solves for you, and you can optimize for yourself and get the best results based on who you are as a human and how you're wired.
And that knowing who you are and how you're wired also plays into, let's just say you want to have a concentrated portfolio. Part of that decision process is going to be, what types of stocks am I going to buy?
Yeah.
Are you going to have a concentrated portfolio that is 50% stalwarts, to use the word you just used, and 50% swing for the fences? Or is it going to be all risky? Or is it going to be all safe? Is it going to be dividends? Is it not? Is it going to be small caps or large caps, right? So you can think less about that if you're committed to having 40 stocks, but you probably need to think a lot about that if you're going to have 10, or 7 or something, or 6 like Buffett, in terms of what actually matters. Yeah. And I think it's interesting, I started out a lot like you did as well, where everything was a fun, shiny object. And I quickly went from 0 to like 120 stocks, I think in less than a quarter.
Yeah. Yep.
And then I've spent pretty much every month or time I've thought about my portfolio since then, slowly whittling it down to, I think as of today, I'm down to 38. But for me personally, it's a weird situation. And this is what I wanted to dive into a little bit. We might as well do it here, which is how concentrated your stock portfolio might be, should be, or I think is likely to be correlated to how much of that is your invested wealth. Because my stocks are 15-ish% of my total investment portfolio. I've said on this podcast several times, I'll say it again right now, I probably should be way more concentrated than I am.
Yeah.
And to get down to 38 was really hard for me, because I looked at it today, Jason. There's 2 stocks I own that I want to sell. I no longer have conviction in them, but they're not material to my wealth. So I'm content to just wait and see if they recover, which I know is not always the most optimal decision. In fact, it probably is almost never the most optimal decision. I probably should just cut bait and move on. And maybe one day I will. But the vast majority of them, I either have high conviction in, or I have, to use Tyler Crow's phrase that we haven't brought up recently, but we talked about a lot several years ago, I have enough conviction not to sell.
Yeah. Yep.
Like I'm seeing green shoots. There's stuff happening that's giving me enough confidence that things might turn around that I'm willing to hold on. So it's hard for me to think about even getting down lower than 38. But for someone who owns 75% of my wealth is in index funds, ETFs, and mutual funds, I probably should have less individual stocks.
Yeah. And I think particularly, again, I think using your situation and my situation is, I think, really good, like kind of opposite ends of the bell curve here.
Yeah. Like I have good stocks and you have bad stocks.
I probably own every stock that you own except for...
Yeah, we do have a lot of overlap. That's true.
Let's be honest here. But the difference, of course, is that my stock portfolio, my invested wealth, is almost entirely in individual stocks. And the percentage that you're exposed to that's individual stocks is what I have in like bond ETFs.
Right.
Because of the work that I do, I have a solo 401k. So I buy stocks in it. I don't buy ETFs. And the vast majority of my wife's working career, the 401ks that she's had were self-directed, meaning that she had the ability to buy individual stocks. So we mirrored her 401k to have the same kind of asset allocation. And that's one extreme that is far less common for most people. More people are far closer to how you are, where they have a 401k or a 403b, maybe a pension as well that might be worth some level of income at some point in retirement. Again, that's your situation. Is probably like closer to like the most middle-class Americans than mine is by far. So as a result, the approach that you should take with the capital, the precision of how you're allocating capital that you can choose to the individual assets that you're buying is going to be, probably should be, to your point, a little bit different than how I'd be doing it. But there's nuance in there too.
Yeah, there is. And one of the things that I have to also realize is not to the same degree to what you demonstrated with Buffett, right? If I sorted my portfolio by size, I'm not in a situation where 70% of my stocks are in the top 6, right? It's way more spread out than that. But I do have probably half the portfolio is a minuscule amount of money. So if I just sorted by cost basis, or even market returns, right, and just cut off the bottom half of the portfolio, it would probably be, I don't know, 1%, 2% of my invested wealth, right? Like I could be pretty, so I probably should, instead of thinking of having, I probably shouldn't say I have 38 stocks. I should probably look at it more closely and say, okay, which of them are a meaningful size, which would probably whittle it down to about 10 or 12, if I'm being honest. So where they're actually, I've put enough into them that I would say within that small percentage of my wealth that is individual stocks, they are outsized proportions of that little chunk. So yeah, there's nuance in that too. Like I don't really have 38 if I'm being honest, because some of them are so tiny that they basically are a rounding error in my portfolio.
Yeah, and it's interesting because that, to a certain extent, you could view that as maybe a flaw or a bug. But one of the things that I want to talk about is how maybe that can be part of a feature of building a portfolio a la the style that Peter Lynch built, with lots of small positions, like almost tracking positions in companies, so that he and his analysts would continue to follow them closely, with the idea that if the business demonstrates management's earned more of your capital, you buy more. Then you start concentrating into that. And if things don't pan out, the losses are smaller. And then if at some point you decide to cut bait, you're collecting a little bit of what was a little bit to start with. So I think that that's something that in your portfolio that maybe you could use, because it's certainly been a big part of how I've invested.
Yeah. And I'm glad you said that, because it reminded me, there's two stocks in my portfolio that I think exemplify this exact thing. So PayPal and ROKU, and they are both small positions. They're both stocks that I have not added to meaningfully in a very long time. Like these are stocks, I bet you if I go back and look, I bought both of these within the first 6 months of buying my first individual stock. Like the first buys probably go back to when I was first a stock advisor member back in 2020. And Roku has done everything in my portfolio. It has been up a lot. It has been down a ton, and it is actually in the green again after 5 years from that initial purchase. And I've always had enough of a bull thesis to not sell my shares. And you and I have discussed and argued about Roku several times over the past several years. PayPal, same thing. I've added to that one more recently. I have a little bit more conviction that they're starting to turn things around. But when I sort my portfolio the way I sort it, I've noticed that where they used to be bottom third of the portfolio, they're starting to find themselves middle-ish, right? As they turn things around, as the stocks slowly recover from where they were. And I could see a scenario, I feel like I'm a quarter or two away with PayPal, especially, of like buying a bunch again, like really making it like, okay, they're on track. I think this is a good time valuation wise to make a purchase. And I'm getting there with Roku, like the recent news where they signed that deal with Amazon, the stock jumped off of that. And I think rightly so. I think that was a good move for them. So if I were, it's tough, because if you ask me like which stocks in my portfolio, if I was starting from scratch, would I buy today? I don't know that either of these would make the cut, right? If I was just starting over, but I do have growing conviction in the two of them. So the fact they are small, again, rounding error size stocks, has kept them on my radar. I don't think I'd be talking about them at all. I'd probably be like, oh yeah, PayPal, I used to own that 4 years ago. I wouldn't even be thinking about it. And because I'm keeping track, if I'm right, if I buy either of these and they actually double from here or better than that, I'll be really happy with myself, patting myself on the back, calling myself a good investor. All right, folks, if you're a regular listener to Investing Unscripted, then you know that we use Fiscal.ai, formerly known as FinChat, daily. Fiscal.ai is our complete stock research terminal. It's where we have our investment dashboards. It's where we create financial charts. It's where we read all the transcripts for the conference calls, sell-side events, shareholder meetings, and it has Morningstar's high-quality research reports on more than 1,700 companies. It really is the complete research platform for stock-focused investors. If you use our link, fiscal.ai/unscripted, you will get an automatic 2 weeks of Fiscal Pro for free. And if you find that it's worth upgrading, you will get 15% off any paid plan with that link. Again, that's fiscal.ai/unscripted. The link will be in the show notes.
Hey listeners, my name is Brett Schaefer, one of the hosts of the Chit Chat Stocks podcast. On our show, we do comprehensive stock research reports, interview analysts, and learn from great investors. And we have coverage on stocks like Airbnb, Nubank, Mercado Libre, and many others. Plus, we cover all the hot financial news on our weekly investing power hours. We have episodes for all types of investors, and think if you listen to this podcast, you will enjoy ours as well. Follow the Chit Chat Stocks podcast on YouTube, Spotify, or Apple Podcasts, and start discovering new investments today.
Let's kind of take a step back and let's talk about a few different things that we've talked around a little bit, but I think are important. We've talked about the idea of managing yourself and learning who you are as an investor. And I think an important part of that is until you actually start allocating money into things that you're choosing to buy, you don't really know, right? What's the no good plan survives first contact with the enemy, right? So no good allocation strategy survives first contact with the market.
Yeah.
And it's true. And you start to learn who you are. You learn a little bit about yourself when you go through a bull market. You learn a little bit more about yourself when you go through a bear market. You go through periods of lots of volatility, macro stuff that you've never gone through that makes the market get weird and affects your decisions. The first time you own a stock that gets hit by a short attack, right? And the stock price falls, right? You immediately hate shorts and you think they're idiots, right? Or you freak out and you sell, right? And you decide, I will always sell if a stock gets shorted because I don't want to go through that. Then the first time you own a stock that goes up on a short squeeze, right? You learn a little bit more about yourself. As much as you learn about the markets and what's going on, you're compounding your understanding of who you are as an investor. But I think the other part of it is learning how to invest, learning how to identify good businesses, learning what good looks like, learning what bad looks like, experiencing what it's like to lose money and be right, what it's like to make money for something that you had not even come close to identifying as being the reason the stock would go up. Like all of those like law of unintended consequences, while you're also building knowledge and experience and hopefully humility, because humility to me sits at the heart of success as an investor, because just when you think you figured it out, the market's going to dunk on you, right?
Mm-hmm. And the humility thing is interesting because you need it. It's helpful. It prevents you from, I think, doing something really stupid that could blow yourself up. But humility, the things that lead you to be humble, I think can also be fleeting, right? So you could see a stock crash that you weren't expecting, and that'll give you a little dose of humility. But it also could just be that a year or two later, it has recovered, So,
right.
But to me, the humility piece is more about, I think it's really important, the least experience you have, the less experience you have.
Yeah,
right?
you are not a humble person at all, Jeff.
No, not at all. No, but the reason I bring it up is like, if I had been 19 or 20 as a new investor going through the second half of 2020 and all of 2021, I might have done a lot more stupid things.
Yeah.
Right. Because you tease me that I'm not humble now. Oh, good God, you should have seen me when I was in my late teens and early 20s. So I think, and there was a time in 2021 where I really thought, not so much like I'm the world's greatest investor, but it was more like, oh my God, this is so easy. Why doesn't everyone do this? And there was enough age in my years of experience to be like, this is probably not going to continue, but I don't know that I would have had that foresight, 20 years prior.
Yeah, no doubt about it. You wouldn't have.
So
it just makes you a normal person.
Right. So speaking of 20 years earlier, this is an aspect of this conversation I wanted to have, which is, do you think differently about concentration versus diversification as you think about where you are with a time horizon? Because one of the things I've wondered, if I was starting out, let's just say I'll pick the age 21, right? I graduate college, my first job, I'm opening up a brokerage account or a Roth IRA, whatever it is, and I'm deciding to buy my first stocks. Is it smarter or less smart, or does it not matter to be more or less diversified the further you are away from retirement?
So this is something I've evolved on a lot. And I think as a starting place, as long as you're investing and not doing dumb stuff, right? Like trading in and out of meme stocks and that kind of thing, trying to chase momentum and trading. But if you're just trying to buy good companies and not do all of the other mistakes, and you're going to learn along the way, right? What those mistakes are. I think that first, call it 5 years, Jeff, which is roughly where you are, right? In your investing career, is like being interested in trying to find and pick individual stocks. You're trying to learn what works for you as much as anything. So I think the biggest thing is being invested and not picking an arbitrary style and trying to stick to an arbitrary style that doesn't fit you, right? That doesn't work. And you're doing it because somebody's told you that that's the way to do it. There's so much to be said about investing and making mistakes along the way to learn about yourself. And when the stakes are smaller, making those mistakes, when you're dealing with smaller amounts of capital and you have a lot more time to offset the downside impact of those mistakes, right? So I think that's the time to really figure out who you are as an investor. And I've definitely come to believe that the best place to start is, even if you have a large amount of capital to put in individual stocks, putting the bulk of it in ETFs, and then building out your stock portfolio, selling off a little bit of it here and there, or as you're adding new money or whatever, however you're doing it, I think is probably the best way because it gets you exposed to the market and getting time in your favor and allows you to kind of explore and figure out what you're trying to do. Because I can promise you that this is something the vast majority of individual investors, when they make the decision to actively start buying stocks, this is the thing that they have no idea about themselves with. There are some that do, but I think they're few and far between.
Yeah, I agree. I like the point about learning and making mistakes when the stakes are low because you just don't have a lot of cash when most of us don't have a lot of cash when you're 21, 22 years old. Mm-hmm. I invested like I was 21 or 22 when I bought my first couple stocks, even though I was 40.
Day trading,
but again, it's so interesting.
Penny stock biotech companies, right?
That's right. Yeah. Anything, because I had no fractional share opportunities and I had $50 in my brokerage account. But the reason I brought that up was even when I started buying individual stocks at age 40, I still had the mindset of I don't want to lose money. Mm-hmm. And unfortunately, that was the mindset when I was 21 that got me locked into a really terrible retirement account that was way too conservative for someone who had 40 years of work ahead of them.
Right.
Because the person I met with to set that up, and I've talked about this before, he did the right thing. He listened to me and I was stubborn, but I wish I had the knowledge to know no, risk is not necessarily losing money when you're 22. Risk is like not being aggressive enough when you have 40 years for the market to recover.
The reality is that your situation was you were not properly diversified in your asset allocation.
Say more about that.
In that 403B,
yeah,
what you've described is that you had essentially no exposure to stocks, right?
Oh, yeah. Right.
So part of how you solve for risk-averse young people is make sure there's enough of the portfolio that the asset allocation is in money markets or cash or extremely low volatility investments, or even things that their beta is negative beta. So like if the market's going down, they're going to actually do well. But when your asset allocation was so completely flipped, you were not properly diversified.
Right.
And in that case, you had a great capital preservation strategy in place, but you had no capital to preserve.
Yeah. And I think I was even, if I remember correctly, I was even in a fund that was downside limited. So I was capped on upside to not have downside.
The premium for certainty, right?
Right. Yeah. I've thought about this too, because in terms of concentration and diversification with younger people, because I have younger people in my house, right? Like I have a son who just finished his junior year of high school. So he'll, within 5-6 years, he'll be out of college and working and making money, hopefully, and having to decide how to invest the money he's saving. So I think I would advise him to do what you said a few minutes ago, which is start with a nice ETF base, and only if he's interested, diversify out from there into individual stocks.
Yeah.
And I think I would say, get to like 25, as quickly as you can, and then add to them over time. I think I would push him into diversification immediately, because you and I see it across social media, people that we interact with out in the world who are so into the get rich quick thing that they're not thinking of concentration in terms of Buffett's way of thinking about it. They're thinking, I'm going to put all my money into this stock or this crypto.
Right, they're going all in on black.
Right.
Yeah. Yeah. No, that's it. They're making a big bet. They're not allocating. Yeah. No, that's exactly right. And I think there's another part of this conversation that's important to remember too, using your situation as an example. So let's say somebody has 20% of their invested net wealth that's liquid, that they can invest it however they choose. So they've got 80% that's in ETFs that are stocks and bonds, and it's diversified. So they own the S&P 500, and then they've got treasuries, right? So super, super safe debt that they're exposed to, and that diversified portfolio. And if they wanted to put a third of that cash that they had, so that would be, call it 7% of their portfolio in one stock. I think that would be a reasonable bet. I think that would be a reasonable thing to do. It might sound hyper risky because I'm taking 30% of my money that I can invest how I choose and putting it in one stock. Now, if it's a shitco and you're being an idiot, you're being an idiot. But it's not because you're concentrating in one company. It's the company that you're concentrating into.
And this is where the temperament thing is important, because the thing that I still, even though I rationally understand it, I still struggle with is, and again, I don't want this to sound like I'm bragging. This is just a byproduct of being in my mid-40s, married to someone in their mid-40s who have been investing a decent amount of their money for 20 plus years. A 1% position in my portfolio is an amount of money I would not feel comfortable watching go to zero.
Yeah.
Even though mathematically it could, and we'd be fine. But we've talked about this before. I won't think twice about putting an amount of money into a stock, and then I will not buy socks I need for 2 months.
You'll spend 2 months researching
socks instead of stocks. No, but like, I think a lot of people struggle with that. So that's where the mindset temperament thing comes into play too with a concentrated portfolio. Because in a world where I only had, let's say, 10 individual stocks, but the same amount of money in those 10 as I currently have in the 38 means that if one of those 10 goes to zero, I'm going to be sad.
Yeah.
And I think that's the other piece of this that's a mindset thing I still have to get over, right? Like, yes, percentage-wise of my invested wealth, it's going to be fine, but that's an amount of money I don't want to lose. I think that's probably one of my biggest hangups and one of the reasons I probably haven't concentrated more quickly. Let me switch the time horizon question. How do you think about concentration versus diversification on the other end of the spectrum when you're closer to retirement? Let's say you get to within 10 years of your retirement date goal, and you've gone this whole time with a very concentrated portfolio. Do you think differently about it as you get closer to having to draw on that money?
I think, and again, this is a data set of two, myself and my wife, thinking about our decisions around our wealth. I think for people that are buying individual stocks, it's probably more likely for a lot of them that portfolio is going to become more concentrated over time. And I think there's two things that are going to happen. The first thing is if you're committed to a buy and hold long-term strategy and you have the mindset and the makeup, the temperament to do that, your portfolio is going to concentrate itself. Your winners are going to win and they're going to become a larger and larger portion of your net worth, and the laggards are going to become less relevant. In my situation, I'll use it as an example. This is just my 401k. This doesn't include my wife's rollover, another 401k, our Roths, any of those other things. With this makes up, call it roughly half of our invested wealth. A little bit less than half. There's 92 stocks and cash. That includes 4 fixed income investments. So some ETFs that are bond ETFs, and then 2 CDs. One is a 5-year CD, one is a 10-year CD. So call it high 80s number of stocks that I own. And then those fixed income investments and cash. The top 20 investments and cash, that's over 70% of that portfolio, right? So there's still a fairly high degree of concentration. If you get into the top 40, it's probably 85% of the portfolio. So there's still a fairly high degree of concentration, even in a portfolio that's roughly 90 stocks. And again, that's largely the product of my winners winning and averaging up. Talked about, the Mercado Libres and TREXs of the world that I've bought more and more of over time. So I think that concentration is going to happen. But where I think it's different for different people is, what do you do with the leavings? What do you do with those edge case stocks that have become less relevant? Do you let them hang around? How often do you go back and trim the weeds and then reallocate it? What do you do with that reallocation? If you've got 10 stocks that you cut out of the portfolio, do you bundle all that together and just spread it across your 5 biggest winners? Do you look for starter positions and other stocks on your watch list? Right? Like all of those different ways you can kind of recycle that capital back into new ideas or your best winners, right? There's a lot of different approaches to take. And I think I will probably always be just so deeply consumed and interested in finding new investments that I'm always going to be looking for those new disruptive ideas that I want to bring into my portfolio.
And that's the hypocrisy of the way I'm thinking about this for myself, which is
it's mental flexibility. I don't think it's hypocrisy.
Well, it's like I want to get down to I don't know. I don't even know what the number is. Let's just say it's 20 stocks, just to pick something. I want to get down to 20 stocks. But I also, if I did that today, like if I sold 18 stocks and got down to 20, I would then want to take some of that cash or all of it. And I'd want to buy probably around 10 to 15 starter positions in stocks I'm kind of interested in. And I'd be right back where I started.
But you'd be somewhere new too.
So I actually did sell some stuff today. I sold Tesla because I only owned that in the Nix Picks portfolio, which I was comfortable getting rid of because we've had it for a couple of years and we can still track the results. It's fine. I sold Applied Materials because that was also in that portfolio, but it was literally like $100 worth of it. And I just don't follow it closely enough It was, and I wasn't interested in following it. So it was out. ASML and Old Dominion Freight Lines, I own them already. So I just cut out that aspect of it just to kind of trim back. But I had a hard time deciding where else to cut in my portfolio. Like I said, there was those two that I'm just kind of waiting on a recovery for, and everything else I don't want to get rid of yet. So I don't know. I don't know how to concentrate further. I guess I just have to do what you said, which is just keep adding to my winners and watch them slowly dwarf the bottom of the portfolio over time.
Yeah, I think there's a mental aspect of that leads to portfolio bloat, right? When people end up owning things that they don't really know why they own and they haven't done well, but they just are waiting for them to get back. And we talked about bias and anchoring, particularly anchoring bias, where I've read this and heard this so many times when somebody says, I'm just waiting for it to get back to even so I can sell it.
Oh, I'm doing that. I said I was doing that.
Why in the hell do you think it's going to go up? You already don't like it. You think it's going to go up? Why don't you buy something you think is going to actually go up instead of waiting for the thing that you don't like to do the thing that you don't think it's going to do, which is the reason why you don't want to own it?
Okay, let me defend myself. I don't want to own one of them. So one of them is Endava, ticker symbol DAVA. So we can talk about it real quickly.
Yeah, you should keep that when it's going to go up.
I don't want to own it, not because it's down. I don't want to own it because I'm not interested in the business. I bought it, again, years ago before I really knew what I was doing. I would never buy it now. I'm not interested in it, but
Editor's note, the only reason Jeff continues to own and has lost money on Endava is because of his co-host on the Investing Unscripted podcast.
That's right. I wasn't even thinking about throwing you under the bus with that, but you did talk me into keeping
myself under the bus here. Months ago, you texted me, you're like, I'm thinking about selling these stocks. And I specifically said, hold on to Endava. And it's down probably 60% since then. And it was already down by 30 or 40% back then.
Yeah. And another one is, and I've talked about this before too, is Celsius, which I just don't want to own it anymore. I don't want to be an owner of any energy drink company. My pickiness around stocks has evolved to where I now stay away from things that are tied to tastes and brands and trends. But I also think it's a compelling product that people like, and it's already recovered a lot of its losses. So that is one where I feel like it could get close back to zero. And I don't need it to get to zero. I just need it to not be like a 4-digit loss in my portfolio. But it's two stocks, right? This is what I mean. Like I'm fully aware of where I'm being stupid. At least that makes me feel a little bit better about being stupid, but it's not like that's half my portfolio. Another one that's just completely crushed in my portfolio right now, but I want to hold on to it because I actually believe in the company over the very long term, is Moderna.
Yeah.
It's going to be a rocky road for a while here, but that's another one that's down a lot that I'm just not willing to cut bait on yet. So yeah, I'm having a hard time getting to the concentration thing, even though, like I said, logically, it feels like I should have less stocks just considering it's where I am. But anyway, I don't want to keep talking about myself.
Let me put up a couple of ideas, kind of a thought exercise to go through. So I think one of the things when we think about the idea of concentration versus diversification, you can have a concentrated portfolio that still has a certain level of diversification. If you own 15 different stocks, that might sound extremely concentrated. And you certainly have market risk. If you have 15 stocks, the market goes down, they're going to go down. But that's not that different than if you own 150 stocks, right? And the market goes down. So you're no less or more diversified against market risk with a concentrated portfolio, unless you own 15 stocks that are all in AI or steelmaking or some other industry where, if we're talking about the market, we're talking about that industry where you have a lot of concentration, you have hyper leveraged your downside risk, right? So I think you can still build a relative amount of diversification even by having a concentrated portfolio of stocks within reason, right? So you're still going to have 6 or 7% of your portfolio, if it's equal weighted across all of them, that's exposed to that individual company risk, right? So you're going to have that. But I think about the idea of a concentrated portfolio, a lot of times like value investors, where they have a very disciplined process where when they pick a stock, they're building in a tremendous amount of downside protection already because of things about the value of the business, whether it's liquidated value or they're figuring out their time horizon and the likelihood that the multiple is going to expand from where it is, like all of those things coming into play. that's when you tend to see the most concentrated portfolios, right? Because they're making those big bets because they've done a lot of work to make sure that they've eliminated a lot of like permanent loss of capital risk, not necessarily volatility, but if I just keep holding, the business is worth this much if you weigh it. And eventually somebody's going to weigh it to see how much it's worth per pound, right? That sort of thing. That's where you see those really concentrated portfolios. But I think for a lot of investors that are not necessarily just focused on buying dividend stocks or building that income portfolio or building a value-oriented kind of portfolio, I think the idea of concentration maybe should be less around the number of stocks and more about how much of the portfolio is concentrated into a number of stocks. So like using your example and my example, probably 30 stocks and cash make up, call it 80% of my portfolio. I think that's reasonably concentrated for what I'm trying to do. And if you look at the way that I invest, when I make big bets, it's in companies where I have a very high degree of belief in what they're going to do. And I've done the work, right? And I know the valuation and the opportunity in my timeline, like all of those things come together, right? It's the confluence of all of these rivers into the ocean of opportunity, and it makes sense for me. So I'll make that larger bet. But I have a lot of companies because I'm always looking for the next disruptor where I take small bets, small exposure, because sometimes they're going to go bad. Wolfspeed's a good example, right? I was pretty bullish on Wolfspeed a few years ago and I took a small position. Wolfspeed just filed for bankruptcy yesterday or the day before, which is going to work out to a 95% wipeout of that particular investment. But it was, 0.25% of my portfolio. It's a very, very small risk of downside risk. I've done the same thing. Mercado Libre, when I first bought it 12 years ago, I bought less than $500 worth of shares. The business was far less proven than it is now. In hindsight, obviously I should have bought more. No, go back to 2012.
That was the right amount. Yeah.
You know what I mean? Over time, I've bought a lot more of Mercado Libre as the valuation has gotten compelling, but the stock price has gone up a ton because the markets realize the business is worth a lot more. So finding a few Mercado Libres erases dozens and dozens of Wolfspeeds, right? Is my point. And I'm not embedding it, and I'm not betting in dozens and dozens of Wolfspeeds, but taking those small bets is a part of my investing style that I have figured out about myself, where I'm fine to own 90 stocks. And at some point in the next 6 months before the end of the year, I'm going to go back through my portfolio and I'm going to sell off 3 to 10 of those losers, but I will have accumulated a few more, right? Like Sentinel-1, for example, is one that I've recently added with a relatively small amount of exposure to that. So even if I'm wrong and Sentinel-1 doesn't carve out a big place in the cybersecurity market, I'm not taking on an outsized amount of risk to get exposure to that opportunity as the company's figuring out what they can be and we're figuring out what it can be as investors.
Yeah, that makes sense. And I think I'm largely like you are in the sense that I like to take bets on things too. I just have to kind of always balance that against my struggle of feeling like I have too many stocks. As we wrap up here, I just want to throw something out to our listeners. We'd love to hear your take on this, how you think about being concentrated or being diversified. I'm curious if anyone has a super concentrated portfolio or if they have a very diversified one. I'd want to hear from you. You can reach us anywhere. The easiest place, honestly, is email. investingunscripted@gmail.com is the way to get us there. Also, before we go, if you guys enjoyed this episode, please share it with someone. Just send it to them on the podcast apps. Also, give us a review and a rating on all the apps. That helps people find the show, and we're trying to grow the audience the best we can. You can also, if you want more content, you can check out our YouTube page where you get episodes of the podcast, but also short videos about stocks that Jason and I do, and Jason does with Tyler and some other folks as well. If you're interested in our community and add limited versions of the podcast, you can check out our Patreon. And lastly, if you want more stock talk, if you want us to see how we put the toolbox and the things we talk about into practice, you can check out our Savvy Trader portfolio and follow our stock picks along there. And the links to all those things are in the show notes.
I feel like all of our links are starting to turn into a Cheesecake Factory menu of links. It's a lot of links.
Yeah, but they're all there.
We're awesome in all of them. So come check us out. All right, Jeff, last thoughts here to wrap this up.
No, I don't have any last thoughts.
I do. A lot of last thoughts. No, I don't have a lot of thoughts. So I think just all I really want to say is learn who you are. I think that's such an important part of this, the idea of concentration versus diversification. And don't try to fall into somebody else's mold, and be willing to change your process over time. That's okay. You're not accepting defeat. You're just figuring out who you are and optimizing to get the best returns for yourself and your family, and to make your process enjoyable and profitable. Figuring out both of those things really matters a lot. All right, friends, as always, we love to give our answers to these hard questions about investing. And this is definitely the kind of question where our answers are not your answers. This is absolutely a question you've got to figure out for yourself. You can do it. I believe in you. All right, Jeff, we'll see you next time.
See you next time.